Hello everyone again. The purpose of this video is to provide a very brief overview of the capital raising opportunities that we're starting to see. As I've mentioned to a number of you during the GFC, we saw a lot of these businesses having to raise capital by issuing new shares. This provided us with an attractive opportunity to buy great businesses at a discount to the current market price and therefore realizing an immediate profit. It's been our expectation that we'd start to see a similar thematic eventuate during this pandemic. And so this gives us a low risk way of increasing our exposure to shares when the markets are low. So there's a few basic things that I'd like to cover in this video. The first is, why do these companies actually do these capital raisings? Secondly, I want to talk about the two main types of capital raisings that companies do. And finally, I'd like to give just a brief overview about how we go about assessing the attractiveness of each of these opportunities. So very briefly, why do companies do these raisings? In a time like this, given the sudden hit to revenues and profitability, many businesses will experience challenges with cash flows. If companies have debts, banks may want these businesses to raise capital to provide additional liquidity to enable the business to navigate through the current cash flow challenge. By issuing new shares to investors, a business is able to bring in additional cash to help resolve the liquidity challenge. In addition to that, it's also worth noting that often share prices will come under pressure as the market anticipates the need for a business to raise additional money. And then once that capital raising is done, that will often prove to be the low point in the share price, because that then shores up the balance sheet and the market then has more confidence in the business's liquidity going forward. So what are the types of capital raisings that investors typically see? So the two main types, the first is a rights issue, and the second is a share purchase plan. So with a rights issue, an investor will typically receive the right, but not the obligation, to buy additional new shares at a fixed ratio. So for example, let's say a 1-for-10 rights issue. So if an investor had, say, 1,000 BHP shares, they would have the right to apply for an additional 100 new shares through the rights issue. The investor is typically guaranteed of receiving all of those shares that they are entitled to through the rights issue. And in addition to that, sometimes we can actually apply for additional shares over and above your guaranteed entitlement. In this situation, you may not necessarily get all of the additional shares that you apply for, in which case you'd simply just have all of your application monies refunded. So the second type of placement is the share purchase plan. We're seeing a lot of share purchase plans coming through at the moment. Through the share purchase plan, the investor can apply for up to $30,000 worth of additional shares. Recently, they've increased it. Previously, it was only up to an additional $15,000. So $30,000 is quite an attractive step up. So this can actually be very lucrative if somebody only has a small existing shareholding, because obviously $30,000 relatively can be quite large and can actually move the dial quite a bit. Nevertheless, unlike a rights issue, you're not guaranteed of receiving your full $30,000 application, again, in which case you would simply just be refunded any surplus monies that are over and above what your application was successful for. So finally, how do we go about assessing the attractiveness of these offers? So firstly, pricing is extremely important. So obviously we want to identify the offers that give us the ability to buy shares at an attractive discount to the market price. The great thing about these placements is that institutions will have to commit money straight away, and then we will typically have a month or so of the shares trading in the market after the initial institutional raising. And that gives us ample time to assess where the share price has been trading relative to the offer price through the placement. So a recent example was Cochlear. where shareholders were given the ability to apply for up to $30,000 worth of new shares at $140. And that was roughly about a 30% discount to the market price at that time. So it was obviously a very easy decision to obviously take advantage of that opportunity. On the other side of this, another example that's currently going on at the moment is QBE. So QBE have an offer at the moment, and the offer price is currently only about in line with the current market price. So it doesn't look particularly attractive at this point. So what we will typically do in that situation is withhold accepting that offer until the last minute. And if the share price is then trading at a decent premium to the offer price at that point, then we'll look to exercise the opportunity. But obviously, if the share price is not trading at a discount, then we'll, at a premium, we'll typically walk away from the offer. The last thing is, once we know what the allocation to the entitlement is, there then needs to be a decision made as to whether we retain all of those new shares or whether we look to trade some or all of those additional shares out into the market at an immediate profit. So this is something that we will determine for each individual investor, but the key considerations are, firstly, the quality of the business and whether this is actually the sort of business that we want to own for the long term. Obviously, the better quality businesses, we will tend to not want to trade out of them and just simply use it as an opportunity to add to a long-term position. The other big factor is your overall exposure that business represents within your portfolio. So obviously, if it's a small exposure, a small existing exposure, then we'll be more inclined to keep that existing position. But if it's already a very large position in your portfolio, then we may consider reducing some exposure trading out in the market. So hopefully this gives you a brief overview of these opportunities, and obviously we'll then be in touch with each of you as these specific offers come through. Thanks a lot.